Welcome to the weekly update, where I'll go over the action in the market for the week of October 14th through the 18th, and then we'll see how things look for the week of October 21st through the 25th. Had another up week, so things are looking quite positive right now. And as we go through the charts, you'll probably reach the same consensus that I reach, where we're looking pretty positive. We still see a weakening trend, but the trend is still positive nonetheless. Some things before I get started. I do a lot more in-depth analysis day by day in the daily videos. If you want to get updates throughout the week, especially those of you that just watch these weekly videos, they're publicly available on YouTube and Rumble, so please feel free to check those out. I do make a PDF available in the description below every video that I post. Some folks find that helpful to download. You can look at the same slides that you see right here, as well as the charts that I use in that particular video. Every day I update pivot points on the YouTube community tab. I can't do this on Rumble. There are pivot points that last through the whole month, and there's another chart that I post pivot points that only last for that day. So that changes every day. I do have a private Facebook group. If you want to check things out, have a little bit more contact with me, and you belong to Facebook, feel free to join that. It's not really active. I also have another program that I'll talk about here in just a moment. If you have no interest in that program, but you still want to have some interaction with me, this Facebook group is a way to do that. I really go through and watch YouTube and Rumble comments. I get rid of all the crap comments. I get rid of all the spam comments because I want that to be an honest back and forth. What a lot of you have been doing lately is just going ahead and sending me emails, and that's fine too. I provide an email address where you can contact me because you want to keep it a little bit more private and keep the crazy people that might read through your comments, you keep them away. I do post on YouTube and Rumble, and sometimes I might have some uploading problems to either one of those platforms. Here's the link to the Rumble channel. And I did mention briefly a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. There's a link that'll take you to the website below this video. There's also a link that will take you to a video about the program itself. Here's an email address where you can send me your comments. If you have any questions about the program, you can do that. And one of the benefits is you get access to the videos as soon as they are prepared. And I'm really been trying the last few weeks to prepare all of the weekly videos so that it's Saturday my time. That would be early Saturday morning for you because I'm in a different geographical location. Okay, and then the daily videos I mentioned before, this is where I really do the analysis, but I do a lot of other videos every week. And all of these are meant to tie into the daily video and be used as a big picture. Let's go back and talk about this week's session. We were up 0.85% on below average volume. There was only one day this past week that had above average volume, and that was the down day that we saw on Tuesday. That's a little bit of a concern. As we've been either going sideways or even going up, we're still seeing below average volume. And that's really surprising because Friday was options expiration day. And typically we see a real surge in volume, but it's not the end of the quarter or anything like that. So we didn't have the massive volume, but we still ended up being below average, even for Friday's session. We are positive overall, and I'll go through the charts and show you that. We still have the 10-year yield, which is above 4%, but it has been coming down. The dollar's really been going up, and that could be putting some pressure on stocks, or at least limiting stocks from going up. And inflation seems to be more friendly right now. And so the Fed has been able to come in and actually cut rates. The only problem is on Thursday this past week, we had some economic reports come out. It was the main economic report day of the week. And pretty much all of those reports were stronger than expected. So now there's a little bit of concern starting to flow through the market saying, if these reports continue to be stronger than expected, that means the Fed may not keep cutting rates. They may keep rates where they're at right now, or they may actually have to come in and raise rates if the economy is looking a little too strong. Now, that's just Thursday. We want to keep that in the back of our mind and then look at all the other economic reports going forward from here and then say, okay, what is the general picture that is developing? Of course, there's a lot of things happening geopolitically right now, specifically in the Middle East, and we've got a presidential election coming up in the US, but the market really isn't concerned about any of that right now. So they're just kind of doing what they want to do. As far as our trend, I will show you this chart. We're in a weakening trend. It's below its moving average, but we're still positive with the green line above the red line. Okay, so just some bullet points to go through here. Stocks ended up being positive for the most part. The small caps only traded the down 5 days, and I'll show you that here in a moment. The S&P and the Dow did hit new all-time highs in Friday's session. We set a couple of all-time highs with the S&P and Dow this past week. And for the most part, we're seeing more broad-based gains across the market, and that just means things are positive. Semiconductors were weaker. There was a report that came out that said the Biden administration may look at curbing sales of advanced AI chips, and they're specifically targeting Persian Gulf countries now. So there's kind of some political things going on here, and that hurt the semiconductors. And they did bounce back, but they still didn't have a really good week. Earnings reports that came out were mostly well received. There was an exception. Now, one reason that I just look at the Dow, I don't really follow it, I don't really talk about it all that much. It's only 30 stocks. And the biggest weighted stock in the Dow is UNH, United Healthcare. So all 29 Dow components could be up. And if United Healthcare is having a bad day, that's going to drag the whole Dow down. And that's what happened. United Healthcare came out with their earnings. It wasn't well received. And so it ended up going down this past week. And then oil, which you would think should be going up because of geopolitical tensions that are going on, it's actually going down. It's dropped below 70. We closed Friday at 68.62. And this is what I talked about a little bit a minute ago. Concerns are growing that the economy may be too strong, which may prevent more rate cuts. And that's just a statement for looking at things right now. Now, we'll have to see this story unfold day by day as the market gets a chance to react to that, as more economic reports come out. We'll just see what kind of a scenario, if any, is built upon this concern. Interest rates were unchanged from a week ago. We closed at 4.07% with the 10-year yield, and the dollar index has really been bouncing up. And I'll show you later on, and if you don't see it here, you'll get it in another video. We came right up to the 200-day moving average with the US dollar index, and it's bounced down from that. Is that going to continue? Stocks typically like a weaker dollar, and this could be putting some pressure on stocks with the dollar rebounding, even though it's still in a downtrend based on the charts we look at. So for the week, the Dow was up 1%, the NASDAQ up 0.8%, the S&P up 0.9%, and small caps, with the Russell 2000 being up 1.9%. And this is a chart that I've been showing for about a year and a half now, just showing what inflation was like as measured by CPI from 1966 to 1982. And we've been kind of tracking that for the more or less most part here. And we're still in that phase where we're coming down. What we need to be not necessarily concerned about, but just at least aware of is that can change. If we really start to see inflation go back up, that could really be some problems for the stock market. But we don't have to necessarily stick with this. We may continue to go down. We may go sideways. We may match this a little bit, but we just want to arm ourselves with as much information as possible. Also, we're above that 4.02%, according to the RenMac research, which suggests that this is potentially biting into corporate profits and the earnings reports. We didn't get an update. We only get this when the employment situation report comes out. But the last time we had this, at the beginning of October, we are seeing an increase of those folks that are longer term unemployed. Then the takeaway from this chart is we're seeing everything going up and to the right here. That just means earnings are still looking solid going out into the future, which can justify prices going up. We did get retail sales that came out. And one thing that's a little bit of a concern here, you notice when retail sales go up and then they level off, quite often we will head into a recession after that. Well, we've been leveled off now for quite a while, even though retail sales were stronger than expected, but we haven't gone into a recession. But there are some folks that are looking at this chart going, well, it's just a matter of time. We're going to go into a recession, and we will at some point. the way the economy's set up, at some point there will be a recession. Whether it's going to happen sooner or later, that's the debate that's going back and forth right now. And we have been going sideways here, but we have a lot of other charts that we also look at that are suggesting, no, we're not going to go into a recession. And the market is not anticipating that there will be a recession. Then looking at the annualized trailing 10-year returns, this is modeled versus realized from 1930 to 2024, just showing here how we've really been going up. And now, according to this model, they're projecting things to go down. But who knows? I mean, this is just a projection. This could turn and actually continue to go up. And gold is still doing quite well. And there's been a lot of people for 20 plus years that have been really promoting gold, saying that you should buy it, buy it, buy it. It's going to go to the moon. Well, it took forever, it seemed like, but it's finally starting to really go up. And then this is also considered to be an inflation hedge. This is looking at it going back to 1920. And then we're seeing a lot of money coming out of China right now, or excuse me, going into China right now, because they've done a lot of things in China to try to stimulate the economy, and it's more stock market friendly. And so you're seeing a lot of money going in there. We're seeing it coming out of Japan, at least in the last chart I saw. And we're seeing an outflow in tech here, but we're still seeing an awful lot of money going in. But lately, money has been coming out. Tech just hasn't been shining since about the middle of July the way it was before, and people are getting a little frustrated with that. And then corporate buybacks. Now, I've been going through a chart in the daily videos that talks about the blackout periods that corporations have, where they're going to present earnings and they can't be buying their own stock back at the same time. It's seen as a conflict of interest. But here we're seeing as the S&P is going up, we're seeing an increase here of the year over year 4-week average of the buybacks. Even though it's lower than it was before, it's still looking really healthy, and that tends to be positive for the market. What's the biggest tail risk right now? Even though a lot of people are saying this, it's coming in first place is geopolitical conflict. They're talking about what's going on in Israel and Iran and Hezbollah and Hamas, but it doesn't seem to really have an impact on the market, at least yet. And then worried about global inflation. It's really dropping off where it had been more concerned about going into a recession. And the reason why there's a concern about an election sweep is that the stock market likes a divided Congress. Democrats, Republicans, they don't really care who's in what side. And they've got friends on both sides. But when it's all Democrat or all Republican that take over Congress, that's when they have a tendency to pass legislation, which means new rules. And the market doesn't like that. And then some kind of credit event, meaning the banking system could run into problems. That's not, it's on people's radar, but it's not seen as a real big concern, at least right now. And then this is just, and again, I show probably 2 or 3 different charts a week showing how much is in money markets right now, and every number is completely different. But according to Goldman Sachs, they're predicting here that a lot of money is going to be coming out of money markets. Okay. Then FactSet had a couple of blog posts because we're just getting going with earnings season here. This is the highest number of S&P 500 tech companies that are issuing positive guidance. And this is just looking pretty positive here. Looking forward, you see the green is going up and the red is going down. That's kind of the takeaway from this post. And then I don't read through all of this, but this is just the earnings update. As of Friday, 14% of S&P 500 companies have reported. Of those that have reported, 79% are above their estimates. And then when you take it together, earnings, they're 6.1% above estimates for right now. And this is going to go up on the percentage basis as we work our way through earnings season. So looking at the intraday chart here, or on Monday, we actually gapped higher and we're looking quite positive. Tuesday ended up being the big down day. And then we kind of clawed our way partway back on Wednesday. We actually gapped higher, but then ended up closing lower on Thursday. And then we looked a little more positive here on Friday and ended up being up for the week. So looking at just the 5 trading days for the past week, all of the indexes were positive except for the NASDAQ 100 and the NASDAQ. They're getting under a little bit of pressure right now. Going back to the beginning of the year, all of the indexes are positive year to date. The different sectors where we had utilities doing the best and real estate, these Utilities, again, it's hard to know. Is that a growth area because of AI and all this Bitcoin and cryptocurrency mining? And there's a real need for electricity. And so utilities have really been going up. Real estate has been doing better now because interest rates are at least lower than they were, even though they've been going back up lately. The financial sector is looking really solid right now. And then some of these other areas like materials and industrials, these are more driven by the economy. They tend to do better when the economy is doing better. Where we have discretionary and communication, those tend to be more growth areas. And tech is another growth area. And healthcare, it mainly got dragged down by United Healthcare, and then energy has been under pressure past week. So looking at their scooter score over on the right-hand side, we have three sectors that are in the 90s: utilities, real estate, and financials. Those are the strongest areas of the market right now, with energy being the weakest. So looking at the 5 trading days for the week, kind of split down the middle here, where we had industrials, healthcare, tech, and energy negative on the week. All of the other sectors were positive. Year to date, we still have utilities doing the best, followed by financials and communication. And then the way I measure it here, all of the other sectors have been underperforming since the beginning of the year. We look at the relative rotation graph, where we're seeing a real weakening here of real estate and utilities. Even though these are the strongest areas, they have been not doing as well. Now, this goes back over the last year, where we see XLP, which are staples. They've also been seeing a little bit of weakness. Then we have healthcare. This is the area that's kind of concerning a lot of folks, is tech, XLK. It's improving. It's starting to turn up, but it's still in this minus area right now. And then we look at it more in spreadsheet form, where you have real estate, utilities, financials, industrials, and discretionary. They're performing the best over the last year, with staples doing pretty good. And then more neutral are materials. And then the negative areas would be energy, tech, communication, and healthcare. And those are all compared to the S&P 500. Then looking at just the indexes itself, where we're seeing the utilities showing some weakness lately after they had been performing well. Now, this is the index itself, not just the sector. We have the S&P 100 and S&P 500. They're trying to improve a little bit, but have been seeing some weakness. This is the Dow Jones Composite Average. We're seeing a little bit of improvement with the mid caps, and the trannies are also not, they've been languishing for all of 2024. And another area that's concerning folks is the NASDAQ 100. It's trying to turn up here, but it's still underperforming over the last year when you take all of this together where we're at right now. And then here's the spreadsheet look here. Transportation actually is looking a little bit better, which would really help the market overall. The mid caps, which has been another area that's been underperforming, and then the Dow Jones Composite. The more neutral areas would be utilities, S&P 100, S&P 500, where we have the underperforming areas of the NASDAQ 100 and the small caps. Looking at sentiment, we did get the latest reading of Investors Intelligence coming in at 2.6. That's more neutral, so we're not seeing a real lean one way or the other. And then just to give you an update here, I just do a screenshot of this before I get ready to record the video, where for quite a while, Harris was ahead of Trump. Now it's really kind of switched and gone the other way. And this is a betting site. This isn't just looking at historical types of different surveys that they take. These are people that are projecting, looking forward from here, and they're actually putting real money down to do this. Then we're getting a little toppy here when it comes to the fear and greed index. We're getting up to 75, and we hit 75 after Monday, and then boom, we had a down day on Tuesday. Is something like that going to happen from here? We don't know. We're still looking positive for right now, but when we get to 75 or above, that's when we start to get concerned about sentiment. And here's a historical chart here where we're right back up to 75. Now, there was a period of time earlier in 2024 when we hung around this level for quite a while. So just because we get up here doesn't mean we're going to immediately turn and go the other way. But at some point, we will see sentiment start to drop, and that may be because stocks are starting to drop. But we're not seeing really much evidence of that yet in any of our charts. The active asset managers, after almost getting extreme positive, did back off a little bit, so they're more neutral right now. Here's that same number coming in at 81.68. Still positive, but dropping from the previous reading. And the VIX finally dropped under 20. I mean, here we have the S&P hitting all-time highs, and the VIX is above 20. Very strange. And so some additional charts that I look at are screaming at us saying, beware, beware. But the market really hasn't done anything about that. And so those flashing signals are still there. But we are dropping a little bit with the VIX, but we're still getting a really high overall reading. When we look here at the line chart and the bar chart, this is still looking positive though. When this black line is going down, that means the tech sector is outperforming cash. And the right X bear bull ratio is very low right now as folks are more positive on the market. This really goes up when folks are more negative on the market. Also index still below the moving average and declining, not really showing any fear here. And we're not seeing a real note of caution here. When we look at the spread between risky and not as risky bonds, we're still getting very low readings. So on the next chart, I inverted that. And when this goes up, that means that risk is going down. And this is inverted to try to match up with the S&P. And then there's also an inverted version of the VIX here, which has been actually coming down. Here, it looks like it's going up as fear has been slightly coming out of the market. But this is not really causing us any concern at this point. The latest reading from the American Association of Individual Investors, they dropped down a little bit. They're still looking positive, and the 50-week moving average is still going up, but they weren't as positive as they were a week ago. We look at the VIX and then a 3-month average of the VIX and do a ratio. That is starting to go back up. That means the VIX is outperforming a 3-month average of the VIX, and that can tend to be more negative, but the market's not really paying attention to that right now. And we look at the 253-day equity put call ratio, where it continues to decline, and that tends to be positive longer term. The latest reading of the National Financial Conditions Index, we're still below the black line. If we go above that, that's when we get concerned. The latest reading from GDP Now has us at about 3.25% for GDP. The forecasts are about almost just under 3% to the upside and just under 2% here to the downside. The takeaway from this is going forward, we're seeing GDP positive. If it drops negative, then we fear going into a recession. And even going forward here, looking at the Goldman Sachs chart, looking out, whether it's Goldman Sachs, these kind of grayish blue areas, or these black diamonds, the idea here is that we're positive, and that's a good sign for the economy. And we did get this reading updated when the employment situation report came out. We're at 0.15. That's the point where the red line is here, and so there's a little bit of a concern with that. And we did get on October 1st, the smooth U.S. recession probabilities. It's going up just a little bit here, but we're still well below the red line. Not a concern there. Here's another look showing we're above the black line, but we're still below the red line. And then this is updated quarterly, the Brave Butters Leading Index. It's continuing to go down, but this takes a long time to update. The inflation nowcasting, not really much adjustments as we worked our way through the week. It did come down a little bit here, but we're not seeing much of a change, whether we look at CPI or PCE. And then not really much of a change here, where after the meeting that meets on November 7th, there's a 90.4% chance that there's going to be a 25 basis point cut there. And that's what the markets, they were thinking, well, why don't they do a 50, or even more than that? With those strong economic reports that came out this week, this is more of a conservative approach right now, but we'll have to see if this can adjust. And you can see the market's pretty much locked that in. And Chairperson Powell actually pretty much came out and said that. Now, that could always change based on the economic reports that come out, but they're pretty much anticipating a 25 basis point cut. Looking out to the December meeting, there's a 76.8% chance that they will cut interest rates another 25 basis points at that meeting. And they're more locking into that idea currently. Here's the Fed balance sheet, which I always comment on this. We're going down with the chart, but we're going up with the numbers. Go figure. Only a government chart can do that. This is the year-over-year change. Well, this is going up, and this number's going down, which is more explainable because it's a year-over-year comparison. And we just want to keep an eye on this. These are the overnight reverse repurchase agreements. We're not really seeing anything all that crazy at this time. Looking at breadth, we're looking really positive with this. Both when we look at the weekly chart here based on price and volume, we're setting all-time highs with this chart, and we're setting all-time highs with the daily charts as well. Seeing a lot more new highs than really any new lows, but it's not enough to really turn our 4-week back up with all that much conviction. However, the 10-week moving average is continuing to go up. We're getting a little extreme at the 19-week advanced decline ratio here, but still looking positive as we're well above zero. Here's the condition of the trend where we're still below the moving average. We're trying to turn back up, but this suggests a weakening trend. Now, if we could turn back up and go above the moving average, that would suggest a strengthening trend. And we have the green line above the red line, so that means we are positive. The Erin indicator still, you could say, is extreme positive, and we're seeing a very similar reading on the daily chart right now. And this measures buyers in green and sellers in red, and then it calculates the difference between the two. And it just says right now, buyers are in full control. The mass index is not generating a signal right now. And then looking at the daily chart, where we're keeping an eye on this pivot point right here. This has already been providing some overhead resistance. There's also a pivot point on the Dow where it's gone up to that pivot point and has not been able to break through that. We're just going to watch this and see if this will cause any kind of problems as far as providing overhead resistance. And then on the daily chart, we were below average with volume for every day except the down day we had on Tuesday. But when we look at the Keller market model, we're positive across all time frames, across all the different indexes. We are negative with bonds based on price in the short and intermediate term. We're negative with commodities in the short and long term. And the dollar's been bouncing back up a bit, so it's actually turning positive in the short term. And longer term, we're still doing good with this chart going all the way back to 2009. And we're still well above an advancing moving average here with the 50-week simple moving average. With the crossover, we're above both lines and going up, setting an all-time high with the S&P. That's positive. And here's another weekly chart. We're well above this R2 pivot level here, looking quite positive there. And if you go back to the beginning of 2024, here's the dip that we saw in the spring, the dip that we saw in the summer. But overall, this chart is really looking quite healthy. We look at accumulation distribution. We're above an advancing moving average. We're a little bit concerned that the boom indicator's getting kind of high right now, so we might be getting a little far away from that moving average, which may cause this to come back down. The McClellan oscillator crossed back above zero. That's positive. And the summation index is still looking extreme positive here based on price and going up based on volume. So this is looking more positive now. Bullish percent index, we're getting a very high reading on the daily chart. We're also seeing that here on the weekly chart. And this has pretty much stayed here for the last couple of weeks. This suggests that the gains that are seen across the S&P 500 are holding for the time being. And we're positive when we look at the Swenlin trading oscillator based on price and volume. They're both going up. And momentum is trying to turn back positive here. We went back up based on price, and we're going up based on volume. So we're looking a little bit better with the PMOs that are rising. The buy signals are going up, and we're still getting a very high reading with the PMOs that are above zero. And we're also seeing the same reading on the daily charts. And there was one day when we, on the daily chart, closed a little bit outside of the upper Bollinger Band. That was Monday. Well, we never did close outside of that here on the weekly chart, but we're still looking quite positive overall. Ticket money flow, we're a little bit concerned about that on the daily chart because it's been declining on I think it's picking up the below average volume, but it's still looking pretty solid here. We're going up with the red line, and the histogram is going up as well on the weekly chart. So we're looking more positive here with the slope in the short term, turning back up with the TSI. We're turning back up with the intermediate term oscillators here, the MACD, the PMO, and PPO, trying to turn up with the tricks, still turning up but negative with the KST. So we're seeing a lot of improvement here, but not full-blown positive, at least yet. Chaikin oscillator above this green line, getting up to this red line, that's positive in the way it's moving. But if it goes above this red line, that could be a bit of a concern to us. The force index is still looking positive and is green. We're starting to get extreme positive with the Stochk RSI. The money flow is just under being extreme positive, but is positive nonetheless. The rate of change, because we had another up week, we're above zero. Going back 50 weeks, actually coming down a little bit, but still looking pretty solid overall. The special K chart, we might finally see a cross here. We've been going up since October of 2022, and this thing just will not cross positive. It's positive on the daily chart, but it has yet to cross over positive here on the weekly chart. The RSI going up and not necessarily extreme. That's showing good, solid momentum. The Williams percent R is extreme positive, also good momentum. And the Vortex, we'd like to see the green line going up more, but it is above the red line, so this is still positive. Ultimate oscillator above 50, that's still positive. The copy curve, we're starting to switch back over positive on the daily chart. We're actually turning more positive here on the weekly chart as well. And we're well above all these moving averages and Fibonacci retracement levels, so there's really no need to go through this chart. On a trending basis, with the weekly chart here, we're looking positive with the Heiken Ashi. The Kagi chart is positive with the black line pointing up. The Renko chart has open blocks. That's positive. The 3-line break is also looking positive as well. And the ease of movement, we're just kind of dancing along here with the 14-week, but we're above zero, so that is positive. And we did draw in a new X here this past week. This is positive. When we look at the point and figure chart, we're still working off of a triple top breakout that was generated on September 16th. As far as momentum, we're still looking like we're going up here in the long term, intermediate term, and we're flattening out in the short term. And we're keeping an eye on the 50-day cycle. I'll probably, as we get a little closer, calculate just what that date actually is. It's probably beginning of November. And we are positive when we look at the Elder's Impulse system for the S&P. We're positive with the parabolic SAR since the dots are underneath. And we're looking good here, setting all-time highs with the S&P. Looking good here with the mid caps. Small caps still have yet to really break out of this sideways range that they've been in. But when we look at the Dow, setting an all-time high, looking quite strong right now. The NASDAQ, not at an all-time high yet, but still above both of the moving averages, so looking solid there. NASDAQ 100 also not at an all-time high yet, but looking positive. And we're not quite back to these previous levels here with the QQQs. This is another look at the NASDAQ 100 weekly chart. The mid caps breaking out, looking quite solid there. And the small caps looking okay, looking positive, but not breaking out, at least yet. The NYSE setting an all-time high here. That's a broad market measure. The Wilshire, this is a daily chart setting an all-time high on Friday. That's broad market and positive as well. We're looking stronger here when we look at the 30 biggest software companies in the U.S. All stocks, both stocks in the U.S. and internationally, setting all-time highs here. The FANG index not back to the all-time high yet, but still looking positive. ARC just kind of plowing along sideways, still in a downtrend overall, even though it was up almost 3% on the week. And the banks are looking quite solid right now. We're actually getting a little extreme here with the RSI. You can see the chart looks quite positive overall. We're starting to turn back up with the momentum longer term. And here is the seasonality chart where this is for October, where we're up 60% of the time, going back to 2020 with a return of 2.3%. And then here's looking at just Dow theory on a weekly chart, setting an all-time high with the Dow. We're looking better with the transports, but we're not even close to the all-time high that was set back in 2021. Utilities looking solid here, but we're wondering, okay, they seem to be hitting some overhead resistance right now. Commodities are still in a downtrend. They really had a solid up week last week. They pulled back in the past week. And the dollar, after coming down to 100, is now bounced up. Now, if you looked at this on a daily chart, this red line would be about equivalent to the 200-day moving average. And we've not been able to break above that. So that's what we're watching as far as the dollar is concerned. Oil dropping down and actually going below 70. Gold setting an all-time high here with the ETF as well as the futures contract. Silver also breaking out, looking a lot more positive. Copper is still in an uptrend. That bodes well for the economy. And then looking at the price of bonds, they are falling back here, but we're still in a longer-term uptrend. And the monthly chart of the stock-to-bond ratio shows how stocks continue to outperform bonds. This is a daily chart of the yields, how we were really coming down and then starting to go back up. And the market really wasn't paying attention to that. We're wondering if they're going to start paying attention to that. Here's a weekly chart looking internationally with US, UK rates at the top, then German rates, and then Japanese rates down below. Then here's an intermarket analysis chart where we have gold doing the best year to date, followed by stocks. Oil has really dropped off and is a little bit underperforming even the dollar. That's the green line. And then bonds are negative year to date based on price. We look at a ratio between the NASDAQ 100 and the S&P, showing how the NASDAQ 100 is underperforming, and we've actually seen a recent death cross with this ratio. The S&P 100 compared to the S&P 500 shows those big stocks are still holding up quite well. Growth to value shows growth outperforming value, and that's what we want to see in a more positive environment. Low volatility stocks, these are what folks get into when they're more defensive. We are in a downtrend when you compare it to the S&P longer term. And bonds are underperforming stocks. When we look at the weekly chart, gold, even though it's setting an all-time high, it's not really outperforming stocks by all that much, although this ratio is in an uptrend. And gold has been going out. We've seen a little bit of weakness in the dollar, and so that's why this ratio continues to go up. And discretionary to staples, we want discretionary to do better, but when we look at this ratio longer term, it's in a negative trend where staples are actually outperforming discretionary. Energy is really underperforming tech. And this is small caps to the tech sector, showing how small caps, even though they're doing better and they could potentially come to the point where they might break out, they're still underperforming longer term. Then looking at some long-term charts here, this is still looking quite solid. Here with the NYSE breadth thrust, this is the swag NYSE breadth thrust. This is still looking positive. And this just shows you what the results were historically going back to 1945, whenever a swag NYSE breadth thrust had been triggered. And the further out you go, especially 1 year, it's even 6 months, it's got a perfect track record. Here's a long-term chart of the S&P going back to 1987, still looking solid here. Here's a further breakout of that same chart, still looking quite solid there. We're still on a full-on Zohorchak buy signal. And we look at the NASDAQ 100 weekly chart, still looking quite solid there. We look at the new highs and new lows. They're starting to go back up now, and they're above zero, so that's showing a real improvement. The S&P new highs minus the new lows going back up, also suggesting good strength internally. And we're still hanging around this red line when we look at the NASDAQ 100 to Dow ratio. It's not falling apart, but it's not really breaking out to the upside either. We look at the QQQs, which is the NASDAQ 100 to small caps, also hanging around this blue level here. And we look at the cumulative new highs, new lows for the NASDAQ. It has been starting to go back up after years of declining. And we want to keep an eye on the 3-month yield. It had really been coming down. Now it's starting to go back up, just because that's what happened back in 2007 going into 2008, and then that brought us into the great financial crisis. We don't know if that's going to happen or anything like that's going to happen. So we just are keeping an eye on this and want to be aware of this for right now. And then just an update of the Hindenburg-Ullman. We did have the initial signal. It was signal that came on September 5th, and then the confirmation came on September 12th. That's the two spikes that you see right here. It would be even more to this chart's advantage to generate even more confirmation signals, but we haven't seen those yet. And this can be negative. Nothing like this is really starting to develop yet, but we just want to be aware of this because this is what happened right before the whole COVID plunge. This is also what happened at the end of 2021. We just want to know what's going on here. Then seasonality, October tends to be up 60% of the time with a return of 1%. But then we've been going through this period of time here where we should see some weak seasonality, but we just didn't. This year really just didn't stick to those historical norms, where October does tend to be positive. If you go back to 1950, looking at this on a world basis, October also looked positive. But when you look at September and October, going back to 1928 during an election year, both September and October can often be negative. The first half of October tends to be really well performing, or the second half, not so much. It's positive, but doesn't perform as good as the first half. And we're getting up close to that first half now being over. And then we look here of September and October, where this is after August, where a lot of times we typically see some weak seasonality. But to this point, we just have not seen that. And looking at both the NASDAQ and the S&P, where September and October are quite often weak, but not happening this time. And we go from August through October, where that whole period of time can often be weak. And then during an election year, that's when things are often weak as well. But we're just not seeing that, at least yet. And then we're in the fourth quarter, where we typically see things performing better. And then going back to 1950 with the S&P, we're up 9 out of 18 times. We're down 9 out of 18 times with a return of minus 0.9%. So thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.